Good evening. My name is Evgenia Solovev. I'm a student of Trust Administration and Wealth Management graduate program here in Campbell. I'm graduating in August of this year. I'm a remote student. I live in Kansas. I work for Sunflower Bank Wealth Management Operations Department. First of all, I wanted to say thank you, Professor Osborne, for this opportunity to take this class. To be honest with you, it has been the most challenging class I had so far in my graduate school, but honestly, it's been very rewarding. I learned a lot during this class. I was exposed to so much information. It opened up so many different career opportunities for me I didn't know existed before. I really enjoyed our lectures, especially our guest speakers. I was very impressed with the lecture with Secretary Pacini, and she's actually the one who inspired me to choose today's topic for my presentation. So I will be presenting today about cybersecurity risk in banking. I'll cover the insurance coverage gaps, risk management challenges. Cybersecurity risk has become one of the most significant and quickly growing threats for many organizations, especially banking industry. It's developing as quickly as technology does. Early cyber threats were simple and usually involved computer viruses that affected individual systems. As technology progressed, cyber risk also became more complex, expanding into network-based attacks and application vulnerabilities. For a scholar article by Fadziso, the cyber risk is no longer limited to isolated incidents. Instead, it has become more systemic when a single event can impact multiple organizations at the same time. This trend accelerated during the COVID-19 pandemic. The rapid shift to remote work increased the number of access points to financial systems and created new opportunities for cyber attacks. Cybersecurity risk is also increasing as financial institutions continue to expand their use of digital technologies such as cloud systems, online banking platforms, mobile applications, and automated payment systems. While these digital systems are efficient for customers, they also increase an exposure to cyber threats such as ransomware, data breaches, business email compromise. Per article by Vishnupriya, online banking systems, for instance, are especially vulnerable because they depend on continuous connectivity and authentication systems that are exposed to both technical weaknesses and human error. As banking systems become more complex, cybersecurity risk has also become more dynamic. Per article by Abrahams, organizations must implement adaptive cybersecurity strategies because cyber threats evolve quickly and cannot be fully secured using static defense. Because of this, traditional risk management methods that focus mainly on prevention and internal controls are no longer enough to fully manage the cyber risk. Cyber insurance has developed as an additional risk management tool. It allows organizations to transfer part of their financial losses from cyber events to the insurers. Per article by Tsahu, cyber insurance should be used together with cybersecurity controls, not as a replacement. Both prevention and financial protections are needed to manage the cyber risk effectively. Now let's talk about cybersecurity risks. As I mentioned before, nowadays banks heavily rely on digital platforms and cloud systems. Per our textbook, the uncertainty in estimation both frequency and severity is challenging because single cyber event can range from small disruption to large financial losses, and it's so hard to predict. Another key issue is that cybersecurity risk is interconnected across institutions. Financial institutions depend on shared systems, third-party vendors, and cloud infrastructure, which is explained by Peters in his article. It creates systemic risk where a single event can affect multiple companies at the same time. Cyber risk is also varies across institutions. Larger banks typically have stronger cybersecurity systems and more resources, while smaller banks often operate with fewer technical and financial capabilities. Now let's talk about real case scenarios that happened in banking and financial services that show how cybersecurity failures can result in financial losses, regulatory enforcement, and legal liability. So here's a case of Equifax data breach of 2017, which happened because of a known software bug that didn't get fixed in time and attackers took advantage of it. It exposed sensitive personal information of approximately 147 million people. The Federal Trade Commission reported that it resulted in regulatory enforcement and a settlement of $425 million. The second case is the JP Morgan Chase breach of 2014, which affected approximately 76 million households. It was caused due to a missed two-factor authentication on one of their servers, which led to exposure of personally identified information of the clients. This case led to increased regulatory revenue and stronger management controls. The last case is the Capital One breach of 2019, which exposed over 1 million customer records due to a cloud misconfiguration. It resulted in over 300 million in fines and costs. In his article, Khan notes that the company incurred over 300 million in fines and remediation costs. This case demonstrates that financial institutions remain legally responsible for data protection even when using a third-party cloud service providers. All these three cases illustrate that cybersecurity incidents often extend beyond operational losses and result in regulatory penalties, legal exposures, and increased compliance obligations. Our textbook talks about traditional risk management framework, which includes 4 main steps listed on the slide. It helps financial institutions understand and manage cyber threats, even though cyber risk is more complex than traditional risks. First step is risk identification, which means recognizing the types of cyber threats banks may face. This include ransomware, phishing attacks, unauthorized access, data breaches, and system disruptions. The second one is risk assessment. Risk assessment focuses on understanding how likely a cyber event is to happen and how serious the impact could be. This step is difficult in cybersecurity because threats change quickly and there is limited reliable historical data. As we know from our textbook, that uncertainty in estimating both frequency and severity is a major challenge in managing new and emerging risks. In banking, this becomes even more complex because a single cyber event can range from small disruptions to large financial losses. Step number 3, risk control. It refers to actions banks take to reduce cyber risk. This includes technical tools such as encryption, multi-factor authentication, firewalls. It also includes non-technical controls such as employee training and internal security policies. In his article, Abrahams explained that effective cybersecurity requires multiple layers of protection working together. However, even strong controls cannot fully eliminate cyber risk because attackers constantly change their methods and human error still plays a role. Step 4, risk financing. This is how banks manage financial losses after a cyber event occurs. Cyber insurance is one of the main tools used for this purpose. It allows banks to transfer part of their financial risk to insurance companies. However, cyber insurance has limits. Adverse selection can occur when higher risk banks are more likely to buy insurance. Moral hazard can happen when insured banks reduce their cybersecurity efforts after buying coverage. Another challenge is that cyber risks are often connected across institutions. Peters in his article explained that this makes it harder for insurers to spread risk because one cyber event can affect many organizations at the same time. Cyber insurance is becoming more important for banks, but it still has several challenges. These challenges affect how well insurance works as a risk management tool and how much protection banks actually receive. Coverage gaps. One major issue is that cyber insurance policies are not standardized. Different insurers use different terms, definitions, policy structures. This makes it hard for banks to clearly understand what is covered and what is not covered. Many policies also include unclear definitions of key terms such as cyber incidents, cyber terrorism, and acts of war. These unclear definitions can lead to dispute when claims are filed. In addition, some policies exclude coverage for certain events such as infrastructure failure, third-party vendors issues, or large-scale cyber attacks. Because of this, banks may assume they have full protection when in reality, important risks. The second issue is underwriting and pricing challenges. It is difficult for insurers to properly price cyber insurance because cyber risks change quickly and there is limited historical data. Zahu, in his article, noted that this uncertainty often leads insurers to charge higher premiums and apply stricter policy conditions. Abrahams in his article also explained that because cyber threats evolve rapidly, insurers must constantly adjust their models, which makes pricing even more difficult. As a result, some banks, especially smaller ones, may struggle to afford adequate coverage. Systemic risk and interconnected losses. Cyber risk is different from many traditional risks because it is connected across institutions. Banks rely on shared technology systems, vendors, and cloud providers. This means one cyber event can affect multiple organizations at the same time. This is a problem for insurers because insurance depends on spreading risk across many unrelated events. When many banks are affected at once, insurers face large losses at the same time, which reduces the effectiveness of risk pooling. Cyber insurance also faces legal challenges. One common issue is disagreement over policy interpretation. This often happens when insurers and banks disagree on whether an event is covered under the policy. A major example is the Act of War clause. Cyber attacks are often difficult to attribute clearly, which creates uncertainty. These disputes can lead to legal cases and delays in claim payments. This reduces trust in cyber insurance and makes it harder for banks to rely on it as a stable management tool. This often leads to large fines, lawsuits, and recovery costs. Banks increasingly rely on cyber insurance as a financial protection tool. However, as shown in the cases above, liability is often broad and can include penalties, third-party claims, and system recovery costs. This creates a challenge for insurers. When legal penalties and regulatory fines are added to the operational losses, the total exposure becomes difficult to predict in price. The regulatory environment for cybersecurity in the United States is divided across multiple agencies rather than governed by a single unified framework. Oversight responsibilities are shared among institutions such as Federal Deposit Insurance Corporation, FDIC, the Federal Reserve System, and the Cybersecurity and Infrastructure Security Agency. Each agency plays a different role in strengthening cybersecurity within the financial system. The FDIC and Federal Reserve focus on supervising financial institutions and ensuring operational resilience, while CISA is responsible for coordinating national cybersecurity efforts and supporting protection. This sector-based structure reflects the complexity of the U.S. financial system, but it also creates inconsistencies in cybersecurity expectations and enforcement. Per our textbook, the risk management approaches often vary by industry, which can lead to differences in how risks are identified and managed across organizations. As a result, banks and other institutions may face different levels of regulatory pressure depending on their size, structure, and authority. A key limitation in the current environment is a lack of fully standardized national cybersecurity framework. Although the National Institute of Standards and Technology cybersecurity framework is widely used, it is voluntary rather than mandatory. This leads to differences in how organizations implement cybersecurity practices. Another important gap is the absence of standardized regulation for cyber insurance. The cyber insurance market is still developing, and there is a limited consistency in policy structure, coverage definitions, and underwriting practices. Tahu, in his article, highlights that this lack of standardization creates uncertainty for both insurers and financial institutions, making it more difficult to integrate cyber insurance into broader risk management strategies. One important step for potential solutions is the standardization of cyber insurance policies. Inconsistent policy language and unclear definitions create uncertainty for both insurers and financial institutions. Standardizing coverage terms would make policies easier to compare and understand. It would also reduce confusion around what is included or excluded in coverage, which would improve trust in cyber insurance as a risk management tool. Improving data sharing between insurers, regulators, and financial institutions is also essential. Limited historical data is one of the main reasons cyber insurance pricing remains uncertain. Better data access would allow insurers to more accurately assess risk and distinguish between different types of institutions. To reduce moral hazard, cyber insurance policies can be designed with stronger cybersecurity requirements. Insurance contracts can require minimum security standards that institutions must meet to qualify for coverage. This encourages banks to maintain strong cybersecurity controls even after purchasing the insurance. Systemic cyber risk also requires solutions beyond traditional insurance models. Because of this, traditional risk pooling is less effective. Clear standards for cyber risk classification, reporting requirements, and insurance regulations would reduce uncertainty across the industry as well. Cybersecurity risk has become one of the most important challenges in the banking industry. As banks continue to rely more on digital systems, cloud technology, and connected networks, they are exposed to a growing number of cyber threats. These risks are difficult to manage using traditional risk management methods alone because cyber attacks are constantly changing and can affect many organizations at the same time. The real-world cases of Equifax, JP Morgan, Capital One show how cyber incidents can lead to major financial losses, data exposure, and reputational damage. Cyber insurance is useful for helping banks manage financial losses after a cyber event, but it does not solve the problem on its own. Cybersecurity in banking is not only a technical issue, but also a broader risk management challenge. It requires a combined effort from financial institutions, insurers, and regulators to reduce risk and build a more secure, stable financial system.
Thank you very much for listening to my presentation today. I hope you found it helpful. Goodbye.